Today is Friday, the 15th of July, and welcome to today's silver analysis. And I want to start off with a little piece I posted on Tuesday night to talk about fundamental analysis versus technical analysis. And what I stated was markets are looking to move into volatility as it seems that a stage 1 or 2 is in play. There are four stages, which start with a stage 1 sideways consolidation from a bottom. Stage 2 is higher highs and higher lows uptrend, and stage 3 is sideways from a top, and 4 is a down move. We just finished a massive stage 4, and the odds seem very probable now that big moves will come back into the market. With the higher volatility, this means the targets on the longer term time frame of 32 and 26 on the downside become easier to hit, as do the upside targets of 39 and 45, and beyond with high volatility. Expect moves in the morning for this chart to start a pattern of higher highs and higher lows. Well, this pattern has now been making higher highs and higher lows. And what happened on Wednesday was the markets were going much higher, and people would say, well, it was because of Ben Bernanke saying this, and maybe a lot of it was one of the reasons for that. But when I noticed beforehand that something was happening, and well, I'm expecting a nice little move to bring us either to the top or the bottom of this range, basically is what I stated, which is exactly what happened. I'm not really all that surprised because the charts told me in advance something like this was bound to happen. So a lot of times you can say it's a coincidence, but if you're not even caring about the news and the mainstream and stuff like that, which personally I think is a good idea because I'm personally transitioning myself into that, I think you can do just fine. Okay, as far as this chart is concerned, it started to break the pattern. Now we're looking to move this into an uptrend. On normal technical analysis, now what you're looking for is for this to match up with this line, start to go higher, and it would go up. If this is something you can't bet on, but it's a tool that you can use to determine what kind of direction this market's going to have. Because when this is going higher, the directions are going to be faster. Now you have to decide if it's going to be bullish or bearish. A lot of times when this market goes up like this, it can start in one direction and finish off in another one. This bottom occurred in April, and the market topped at the end of April somewhere in here. So it just doesn't state one direction. As far as the regular charts are concerned, we will start off within the 6-hour or quarter day chart, end of this 5-day moving average. When we begun this, at least from the downside, it was very choppy, going above and below the moving average. The last time it went below, it barely went below, and I say barely for the fact that it was below it for like 4 candles, with the exception of like 12 or so in here. Therefore, this to me is an area where it found support, has lifted off of the 5-day moving average, and is now in the area where it came close to finding a test, but it did consolidate over the last day or so, each one of these candles representing 6 hours. Therefore, up to the top of this Bollinger Band, it's given itself some time to be able to give it its energy to at least get above this high, and maybe make again a test of this higher band, which is currently set now over $40 per ounce. Now let's move this on to the daily chart, because this is the one that is the most exciting for the day. Not really exciting, but at least something that's giving us some good direction. This Fibonacci line is pretty big. It says 38.14. I've calculated 38.11 in there, and it's really in that area, 38.10, 38.15. Because that's the exponential Fibonacci from the $49.81 highs at the end of April, as well as the $32 lows that were placed in here. When we see what's happened from this point, we already had a Fibonacci test here, which actually was because the last time it bottomed, it was in that same area. Therefore, we found a Fibonacci resistance test here, came back lower, had another Fibonacci test, came back lower, and now we're at this area again. The more often you test a significant level, the more often or the better chances you have of breaking that level. It's now broke above this level and it's holding well. That's all we need to know. We're still waiting for confirmation to continue because 2 candles above is not enough. But what's interesting to note is this candle in here. Normally when you have a candle like this where you close pretty much at the start of where you opened, something like this, that's usually pretty bearish. And if you just look at this on its own, you may be considering to short the silver market or maybe get out of this play. And this is one of the opportunities. This to me shows bullish action, because when you see this candle, what this tells us is that the market broke through the significant resistance area, managed to make it to a level not seen in quite some time, and now it's back to an area that was previous resistance. Therefore, if you're like me, and a lot of times when you see a market breaking out, you want to wait for it to come back to that level of support. Well, that's exactly what happened yesterday. It came back at the end of the day, 5:15 p.m. Eastern Time. That's when the market bottomed. The market bottomed at $38.12, which was pretty much exactly at that level. And then it held that level for a while, and then today it barely went below it again, and now it's riding back above this level. Therefore, if we're finding support here, then we're confirming that this is a breakout above this level, but we still have a little bit to go. As far as the moving averages are concerned, that's another good way of doing it. And that is this is the 18 period average. We're starting off at the beginning. Markets are crashing. You're in this bear market. You come up to this area here where you're now at the 18 period average of lows, and now you want to be a little bit cautious, but at the same point, you're at an area where you can find resistance for the next wave lower. You come down here, you go up a little bit, go sideways, that's correcting through time. But it didn't find resistance, therefore, you went from cautiously bearish to neutral. Now you're neutral in here, you're neutral, getting above it. Okay, now you're below it. Got to find resistance here. Nope, still neutral. Okay, now you're breaking below. You found resistance at this period. It's time to get bearish. It's now a bearish signal. Why is it bearish? Because it did find resistance. It made this lower high. It's broken down below the support level. That's bearish. Okay, now it's time to get a little cautious in here, but that's fine. We're making a pattern of lower highs. That's another lower high. You're coming down to the declining 18 period average. That's normal. Okay, here's a red candle. I told you so. It's going lower. And it doesn't concern me, this candle here. And okay, you're stopped out right here. You're stopped out. You got above the 18 period average. You move back again to neutral with an up bias. This is your breakout here on the long side. Because this moving average started to move to the upside, it was holding it. Still not too sure if it's going to break above it because it's been doing this pattern over and over of going above and below it. So I wouldn't have been buying it here. But now we're getting to the point where you want to start to buy it. And if you're looking to get to that point, this is perfect confirmation level right in here at the 38 level. Final chart is the weekly chart. The week is now coming close to an end. It will be the second consecutive up week in a row. The market is closing above the 18 period average of closes. That's at 37.28. It could potentially even close above the 18 period average of highs. Still not too sure, but at least it's managed to get to the top end of this range. Thank you for watching and have yourself a magnificent weekend. Bye-bye.